You're watching The Close with me, Zinati Guma. Now, on one hand, Clicks continues to grow its earnings, benefiting from larger profit margins and strong cash flows. And on the other hand, Afrimat's profits have taken a knock despite upbeat growth in its top line. We'll be unpacking those earnings reports with CEOs Andries van Heerden and Bertina Engelbrecht in just a bit. But first up, it's your news-making headlines. Strong margins and cash flow generation have given Clicks a boost. South Africa's biggest pharmacy chain has posted a 14% rise in headline earnings per share, and it's lifted its total dividend by a similar margin. Clicks says it expects consumer spending to remain constrained in the short term, but the medium-term outlook is becoming more positive. It cited lower inflation, interest rate relief, declining fuel costs, and the stronger rand. Afrimat's posted a sharp drop in profit at the halfway stage of the year. The building materials and mining group has reported a near 80% decline in headline earnings, and it's pointed to a raft of factors. Afrimat says it felt the brunt of a declining iron ore price, a strengthening rand, and limitations on the export rail line. The group's also cited a poor showing from its cement business. That unit incurred losses for 4 of the 6 months due to reliability issues at the factory, which led to excessive maintenance costs and limited production. Datatec delivered an improved interim performance due to strong showing by Westcon and Logicalis International. The ICT group, which operates in more than 50 countries, has posted a 66% jump in headline earnings per share, and Datatec expects the positive trend to continue. CEO Jens Montanana says all divisions are set to deliver a better full year-over-year performance, despite some softening in certain European markets. The group's declared a dividend of 75 cents. Spear REIT's Western Cape-only strategy is paying off. The property fund says letting demand has returned to the province's office market, where its occupancy rates have increased by 616 basis points. And that, along with a reduction in vacancies, has supported a 22% rise in interim distributable income, supported by a reduction in vacancies and strong leasing activity. Spears added that being free of load shedding for the past 200 days plus has bolstered the sense of renewed optimism within the investment community, and this has led to tenant commitments that were on the fence less than a year ago. Anglo American is mulling further cuts to diamond production as the industry continues to struggle amid prolonged low demand. The mining giant, which plans to sell or spin off its De Beers unit, has reported a 25% drop in third-quarter rough diamond output, but it's maintained its 2024 guidance for the commodity. It's done the same with copper, which also saw a double-digit production decline. Kumba Iron Ore has posted a 3% rise in a third-quarter output and says it's on track to deliver its full-year production targets. But the miner has cautioned that sales are expected to end the year closer to the lower end of its guidance due to a weaker quarterly performance with adverse weather conditions having weighed on ship loading. Kumba's added that low steel demand, robust iron ore supply and elevated inventories at China's ports has put pressure on the iron ore market. But the sector rallied in the last week of September amid stimulus measures announced by China. In international news, Eurozone business activity is stuck in a rut, remaining in contractionary territory in October as demand from both home and abroad fell despite firms barely increasing their prices. Let's take a look at this package report for more.
Business activity across the Eurozone has stalled again this month. That's according to a closely watched survey, the Purchasing Managers' Index. Activity remained contracted as demand from both home and abroad fell, despite firms barely increasing prices. The PMI reading was slightly up in October at 49.7 from September's 49.6. But for the second straight month, it remained below the 50 mark, which separates growth from contraction. It also came in lower than analysts' expectations, with one remarking that the PMI's slight increase from September came from an easing contraction in manufacturing. But that was, quote, hardly something to cheer about. Business activity in Germany, Europe's largest economy, shrank in October, but less steeply than in September, according to its PMI. In France, the dominant services sector contracted at its sharpest rate in 7 months, dragged down by sluggish new orders. The PMI for Britain, outside the European Union, showed businesses reported their slowest growth in 11 months. Also, hiring shrank for the first time this year, as uncertainty ahead of the Labour government's first budget dampened confidence.
And Unilever and Danone topped third quarter sales estimates as they slowed price hikes and invested in innovation to win back shoppers who had turned to cheaper brands. Here's more insight on those numbers.
Consumer goods groups Unilever and Danone beat third quarter sales estimates on Thursday. That's as they slowed price hikes and invested in winning back shoppers who turned to cheaper brands during an inflation surge. During the pandemic, the cost of everything rose, from freight to raw materials, while grain and energy surged in price after Russia's 2022 invasion of Ukraine. It meant the packaged food industry raised prices to protect margins. Shoppers started trading down to cheaper alternatives, like brands owned by Walmart and Tesco. At its peak in 2022, prices at Unilever, maker of Ben & Jerry's and Dove, were hiked up to 17%. In stark contrast, in the last quarter, both Unilever and Danone's price rises were under 1%, and both reported a spike in sales volumes. Unilever saw a rise of 3.5%, the biggest since the first quarter of 2021, and Danone, maker of Activia yogurt and Evian, was boosted by a 3.6% rise in sales volumes, on strong demand in North America for items including high-protein products. Analysts branded these results as reassuring, although not all consumer groups have had buoyant news. Nestlé last week cut its full-year sales growth outlook, battling high costs for coffee and cocoa. Both Unilever and Danone kept their forecasts for 2024.